I told you it's going to be rapid fire. This is another big one. We got a lot of big ones here. Okay, so order regarding net capital computation for Goldman Sachs Financial Markets LP. Goldman Sachs Financial Markets LP has submitted an application to the Securities and Exchange Commission for authorization to use the credit risk standards of paragraphs D through F of Rule 18A-1 to the SEC Act of 1934. Paragraphs D through F require that a firm utilize a maximum potential exposure model equivalent to the VAR of the counterparty's positions, with a 99% one-tailed confidence level, with price changes equivalent to a 1-year movement in rates and prices, or based on review of the security-based swap dealer's procedures for managing collateral, and if the collateral is marked to market daily, and the firm has ability to call for additional collateral daily. Of course they do. There's a repo market. The commission may approve a time horizon of not less than 10 business days. Based on the commission staff's ongoing monitoring and assessment of the firm's internal risk management controls, they're going to go ahead and determine the application meets requirements of paragraphs D through F. Using the credit risk standards of paragraphs D through F should help align GSFM supervisory risk management practices. Why are you helping them? Because the market's going to crash if you don't? Let it crash, Gary. No one cares. Anyways, this is the rule here. Net capital requirements for security-based swap dealers for which there is not a prudential regulator. But that's bullshit, Gary, because we have a prudential regulator. It's you, mofo. The term prudential regulator has the meaning given to the term in Section 3A74 and includes the Board of Governors of the Federal Reserve System, the Office of Comptroller of Currency, the FDIC. Oh, wait a minute. Interesting. Must be Board of Director related for the, Fed Reserve. So let's look at Section D through F. So Section D is... It's lowercase d. Where did it go, Bailey? Okay, so a description of the mathematical models to be used to price positions and compute deductions for market risk, including those positions of the deductions attributable to specific risk, if applicable, and deductions for credit. Okay. And a statement describing the extent to which each mathematical model used to compute deductions for market risk and credit will be used as part of the risk analysis and reports presented to senior management. Okay. So basically, the point of this is they're doing it for here, right? Goldman Sachs. We also have Nomura Global. They met the requirements. We also have Goldman Sachs & Co. LLC. Approved as well. Guess who else? Jefferies Financial Services. Jefferies LLC. Same parent company. Okay, yep, that one got approved too. There's more. We also have, guess what? Citigroup Global Markets. Let's see if they approve them. Yep, meets the requirements. Okay, next, Goldman Sachs Financial Markets. Again, 2 in the same day. Okay, don't worry, everybody. This approval is for the interest of the investors, okay? Oh my goodness. So, any of these names ring a bell? Goldman Sachs, Nomura, Jefferies, Citigroup, Goldman Sachs, Nomura Global Financial, and then Morgan Stanley. That's the last one, Morgan Stanley. Okay, yep, don't worry. Gary just approved, the ability for these people to game their net capital requirements because they likely don't have the net capital requirements. So all these are approved for basically this relief from the SEC. Congratulations, Gary. You did it. You enabled crime. Anyways, that's all I got for you today, I think.